Good morning. Welcome to Member Focus Monday. I'm Christina Schaefer, Social Media Manager for HAR, and I'm joined again by Gerald Klassen. Gerald, this is your second time on our program, correct?
Yes, it is. Good to be
Yes,
back.
yes, and we're really excited to have you back. You bring a really unique perspective to the data, and we love to hear it. I'll have you introduce yourself in just a moment, but for
Sure.
those of you that are watching, I encourage you to go ahead and like this video and share it with your audience. Share it with customers, clients, any realtors that would find this beneficial. Gerald has done a ton of research and analyzed the data, which is his expertise. So he's going to be going through that with us today. He also does have some slides that he provided for us that we'll be sharing with you all at the end of the program as well. So be sure to stick around to get those slides at the end. So Gerald, once again, thank you for joining us today. We're really excited to have you.
Good to be here. Thank you for having me.
So really quick, I know you have been on this program before, but if you don't mind just quickly introducing yourself, what you do, and why we have you on here today as our expert.
Okay. All right. My name is Gerald Klassen. I am the research data scientist at the Real Estate Center at Texas A&M. My big responsibility is to manage and develop the data warehouse for us to produce housing statistics for the state of Texas, for Houston, and to provide more insight into the housing markets. And also, I have a background in financial markets, and so part of the reason I'm here, I think, is to provide insight not only to housing data, but to help folks understand what's going on in the financial markets and how it's impacting the housing market.
Yeah, very good. Again, we had you on a few months ago, and you brought such a unique perspective that we think is important for people to hear. You and I had a little pre-interview, if you will, the other day, and you told me I'm not going to sugarcoat it. So you guys are going to get the real information here from Gerald today. So just generally speaking, if you would, what has been the overall effect of COVID-19 on the market?
Okay. Well, the impact has been big, but it's not only the COVID that is impacting the market. And I put together a slide that I hope your audience will help them understand what is going on, and that it's more than just the virus. These layoffs, the disruption is more than just the virus. And so I'm a visual person, so I put a slide together to talk about the two all the different angles and how it's impacting the market. I could just give a brief summary, but folks wouldn't understand why and what the context is. So
Yeah, they can
I
they
like
can
to
see
write
that slide
context.
now. So
Okay.
yeah.
So the first thing that, and I mentioned this last time, was we had a situation leading into the spring of falling corporate profits. It's very similar to 2008. In 2008, non-financial corporate profits as a percentage of GDP had fallen about 2.3% between 2006 and 2008. The average from when the peak of those corporate profits as a percentage of GDP to a recession, it usually is about a drop of about 1.98%. Coming into the first quarter of this year, it had fallen by 2.21%. Bottom line is corporate profits had fallen to a point where managers were going to start to have to lay off people pretty soon. This was before the virus even struck. The second thing that was really important, and it's a little different than 2008, was the record corporate debt. Back in 2008, we had record household debt. Well, this time we've got record corporate debt. And the problem is it's even bigger than the household debt problem we had in 2008. What's been happening since about 2013 is corporations have been borrowing more money to buy back shares to increase earnings per share. That's boosted stock prices. It's a lot like households that were cashing out equity on their houses and spending the money. That's a lot like what was going on with corporations. They were borrowing money and buying back stock. They were cashing out equity. And that led us to record corporate debt. Well, when you have falling profit and record corporate debt, you're set up for a recession or a crisis of some point. Then COVID-19 happened. And that's produced immediately layoffs as demand collapsed. Businesses had no customers, so they had to do layoffs. It created, and in Houston, very sensitive to collapsing demand in oil, the energy sector really got hurt. And the energy sector has about $650 billion of loans out from banks. So banks are very exposed to the energy sector. It's about 3.5% of bank assets. And so what's happening is the crunch on corporate profits, the crunch on corporate debt has produced a corporate debt crisis. And people may ask me, well, Gerald, I don't see a corporate debt crisis. Well, let me give you some numbers to talk about the size of the issue. Residential subprime in 2008 was about $650 billion. Right now, the leveraged loan market, so these are like subprime corporate borrowers, is $1.2 trillion. High yield bonds, again, subprime corporate borrowers, is $1.4 trillion. So we've got the equivalent of subprime corporate borrowers, about $2.6 trillion compared to the $650 billion of subprime, residential borrowers. And so what has happened is the Federal Reserve has come in with massive liquidity to prevent the collapse in value of these $2.6 trillion of debt. And to give you a little bit of context, in 2009, from 2009 to 2010, the Federal Reserve was purchasing about $23.5 billion of treasuries and mortgage-backed securities per week. In the 15 weeks of this crisis, the Federal Reserve has been buying $147.5 billion of treasuries and corporate bonds per week. 23.5 compared to 147. That's why you haven't seen the corporate credit crisis. The Fed has been putting incredible amounts of liquidity into the market to head off that corporate credit crisis that would make layoffs even worse. And so what we've had in the last couple of months has been this rush for cash. You've had stimulus money, and in April alone, the Fed or the government provided about 6 months worth of retail sales, right? So think about how much consumers spend in 6 months. That's how much money that the government has provided to households to help plug that income gap from layoffs. You've got a lot of mortgage and rent forbearance building up in the system. You've got line of credit drawdowns from corporations to the tune of $124 billion since the beginning of March. And so this rush for cash has tried to plug the gap, but what we've got at the very bottom is a lot of pressure on banks. There are a lot of bank loan delinquencies. You've got delinquencies in commercial mortgages. You've got falling commercial real estate values. And that is leading to tighter real estate lending, which we will see and talk about in the in our conversation here. Banks are significantly boosting lending standards for commercial mortgages and for residential mortgages at the lower end of the market and for jumbo mortgages at the higher end. So all of this works together to put pressure on banks, which is going to be felt in the real estate industry. And that stock market rally, don't believe that for a second that things are getting better because the stock market is rallying. What has happened is that stimulus money is going into the stock market. All of our bored people staying at home, remote workers, had their trading screens up on the side.
Right.
And Fidelity reported 1.2 million new brokerage accounts
Wow.
this spring. TD Ameritrade had another 426,000. Robinhood, the trading platform, has
Mm-hmm.
about 3 million new accounts. So all that stimulus money was money from the house that our households that couldn't get to the casinos started trading stocks. And
Mm-hmm.
so a lot of that stock market rally is being driven by stimulus money. So don't be fooled into thinking that just because the stock market is back up, that the economy is recovering. It's not, because the banks are under extreme pressure, and it's going to impact real estate lending. So I
Yeah.
hope that provides a little bit of a context for what's going on
Yeah,
in the
definitely. And it sounds like it's much deeper than what we are seeing in the news. There was actually a comment from Rhonda. There's not a lot of this information in the news about corporate layoffs, so thank you for the inside scoop on this. So this information is going to be very good. And I did see somebody said they would love to see these numbers. If you missed the beginning, excuse me, I mentioned that Gerald did put some slides together for us that we'll be sharing with you guys on the end, or at the
Yeah.
end, excuse me.
One thing I
Um,
want to talk about the layoffs too, because you're not going to hear about this, because there's a lot of V-shapers out there that
mhm.
are looking for V-shaped recoveries. Is if this were just a virus and people had lots of cash in the bank, cash reserve, businesses had cash reserves, borrowing capacity, we would have had a V-shaped recovery, because it would have been a temporary disruption. Businesses could have covered with short-term debt, households could have covered. But the problem is, businesses, again, going back to the corporate profitability and debt crisis, these temporary layoffs are going to become permanent layoffs very soon. I think
Mhm.
once the PPP program and a lot of the stimulus starts wearing off in the next month or two, we're going to see much more news about the layoffs becoming permanent,
Yeah.
and that's going to make things even worse going forward. That's why I think things are, excuse me, are going to be much deeper than what you're hearing in the media.
Okay. Thank you. Thank you for that. So let's move it into real estate a little bit here. Because I know you analyze the numbers, and you're very in depth in your reporting. Are there any price points or areas, maybe parts of town, that have been more affected than others during this time?
Okay, I'll tell you what, I'm going to start off with a slide that puts some context around what we're
Mm-hmm.
experiencing, because I think it's good to have a little refresher. Is this the
Sure.
apocalypse? Is the world ending now? Well, let's start at the MSA level, at the Houston MSA compared to the other MSAs. And I went and looked back at Houston numbers when things broke loose in 2008. And on a year-over-year basis, uh, in September of 2008, sales, and this is residential, single-family condo and townhouse, new and existing. So this is everything that came through the MLS system.
Mm-hmm.
In the MSA was down 27%, 27.13%. November of 2008 was down 32%. And then the next really bad months were July of 2010, where it was down 25%, and October of 2010 down 25. So it put some context around these April and May numbers. April was down 21%, May was down 22%. So we're not quite as bad as where we were in 2008 in terms of the drop in sales.
Mm-hmm.
And I think people will agree it was a little more severe this time with a lockdown. To be down fewer sales than we were in 2008, I think speaks a lot to the market is a lot more healthy than it was back then.
Right.
When I look at the change in the median price, there again, we're not even close to the drops in prices that we experienced back in 2008. November of 2008, that year-over-year price change was minus 7.8%. December of 2008 was minus 6%. January of 2000, minus 6. And February, minus 8.9. So we had 4 months of horrendous decreases in the median price. And in May of this year, we cracked our first negative number of negative 0.002%, so 0.2%. So I think things are healthier in that respect.
Gerald, really quick, on the year-over-year change in sales, Justin was asking, is this graph quantified in housing units or in dollar volume?
Housing units.
In housing units.
In housing units, yes.
Okay.
Yep, and then the average price tends to be much more volatile, and I'm going to explain to you in just a minute why it's more volatile. But in 2008, November through February, we were down 7.3%, down 11.1, down 13, down 11.4. So we had a string of really weak average price numbers. In May of this year, we cracked our first negative average price of down year over year 6.7%. So pricing has held up much better this time than last time. But here's where this next slide, it's very colorful, but it shows. So what I did is I took the March to May sales. People are wondering, is this period of the crisis, how does it compare to prior years? So I took all the years back to 1999 and took just the March through May sales. Okay, so think about that. We're just talking about 3 months of sales that this year happened to be where the crisis was.
Right.
It's really interesting because between 2019 and 2020, you see a group of price cohorts, but when I break it down to homes that sold for less than $200,000, homes that sold between 200 and 300, and homes that sold for over 300, into those three groups, the market share of the lowest price homes and the highest price homes declined. And the share of homes between 200 to 300 increased significantly. So think about that for a second. The mix of homes being sold has changed significantly between last spring and this spring. So in 2019, those under 200,000 were 35%. In 2020, it was down to 31.1%. Those greater than 300 were 32.8% in 2019. That was down to 31.8 in 2020. But the share of $200,000 to $300,000 homes increased from 32.2% of the market to 37.1% of the market. Why is that? Let's go back to that previous slide that I just talked about. At the low end of the market, what are banks doing? So banks are under pressure. Energy loans, lines of credit drawn down, commercial mortgages in forbearance. They've got huge cash pressures and pressures in their portfolio. So what are they doing? They put more credit overlays at the bottom end of the market, increasing the FICO score, shortening the time of documentation, having a shorter period of documentation to support income. Various other things that they're changing, 20% down. They're making it harder for the folks at the low end of the market because the banks don't want the risk of repeating 2008, making mortgages that right away go bad and end up having to take losses on those mortgages. So they're making it hard for folks under 200,000 to qualify for a mortgage. And then banks like Wells Fargo that restrict the jumbo mortgage, right? The stuff that they hold on book. So the jumbo mortgage market has, been restricted significantly. So that impacts the high end of the market. So bank balance sheet pressure is reducing sales at the low end and the high end. And I don't see that changing for the foreseeable future, given the other things that are putting pressure on bank balance sheets.
Yeah, that makes sense. I just saw a few sad reactions coming through, and And I feel you guys. And again, a lot of people thanking you for this information, as it's very, very important for us to hear. Just some feedback here. A few people said they were guilty of being day traders. Um,
Yeah.
yeah. For those that remain gainfully employed, will this present a really good buyer's market, do you think?
I think so. There's a lot of folks, and the Federal Reserve, and I know Dr. Luis Torres at the Real Estate Center just put out an analysis that shows the large number of folks that continue to work.
Mm-hmm.
People like you and me that have the ability to work remotely and continue to earn income. As long as they're buying in with a GSE mortgage, that the Fed is going to underwrite GSE mortgage, the GSE mortgage market, and drive that rate down as low as possible. It's going to be fantastic. The problem is that when folks have a lower interest rate, they can borrow more money.
Mm-hmm.
When they can borrow more money, they can pay higher prices. So they're not going to be as hard in the negotiating on the price. And what happens is, just because people can borrow more money means they're going to be willing to pay more money, which means housing is going to get more expensive and less affordable.
Mm-hmm.
So yes, it's a buying opportunity. It's going to cause prices to increase when folks can borrow more money. So I would just say keep that in mind when you think about, is this a good time for people, working people, to buy?
Similar, well, not similar, but somewhat similar question here. Luanda asked, have you seen this change with VA applications for veterans?
What's happening is in the government, government or VA, FHA, the credit overlays are increasing there as well.
Mm-hmm.
Okay, so as far as what I've been reading, that's what I'm seeing, is that they're also increasing on the government purchase as opposed to the GSE. So that's about what I can respond on that.
Okay. Do you happen to know the acceptable credit score for, it says, do you know what FICO score is now more acceptable for buying a home? 620 was a pretty doable benchmark.
So what I've read is JP Morgan has bumped up their FICO score minimum to 700,
mm-hmm.
And requires a 20% down payment.
Okay.
It's pretty. They're basically, JP Morgan is kind of withdrawing from the residential lending market.
Mm-hmm.
U.S. Bank has upped its minimum credit score to 680. It varies bank by bank, but I think they're going to be looking for scores that are closer to 700 than 600 going forward.
Okay. So back to my initial question, we talked about the price points. I'd like to hear about the parts of town, because as you know, we have members spread out all over Houston. So are there any particular parts of town that you've seen more affected than others?
Okay, this is very interesting because I've been watching the numbers,
mm-hmm.
And as you know, we've been working on some new statistical, weekly series
mm-hmm.
for Houston, and we've been looking at these numbers around the state, and it seems to be that the counties at the central or the core county of the MSA is recovering slower than the surrounding areas. And this includes Austin, Dallas, Fort Worth, and San Antonio. So Harris County has been coming back in terms of new listings and reported closings, and that has been slower in the dense core county than in the outlying counties. So early on, it looked like either the lockdown didn't mean as much in the rural areas and
mm-hmm.
there was still business going on, or maybe folks in the crowded areas are starting to look for homes in outlying areas. One thing that was very interesting is American Homes for Rent and JP Morgan announced a partnership to build houses for rent in outlying areas around cities. Now, that just didn't happen in March. They had been thinking about that for a period of time. So it's making me think that between the virus and potential changes in particularly millennial households that maybe have a few young kids that are ready to get out of the more dense areas, this virus was that final catalyst to send them out to the suburbs to get away from the high density, the risk of infection, as well as just ready for more space in outlying areas. So what I see is potential strength going forward in outlying areas.
That makes a lot of sense. So last time you were on this program, you shared the effect of iBuyers on the market, which was something that we hadn't been able to really measure before. What is their current effect, and what are you seeing there? And do you see them returning to the market soon?
Okay, so one thing that iBuyers, I call them iBuyers, or instant offers, cash offers, have been around for a very long time.
Sure.
OfferPad and Open Door are very recent. That business has been going on for a long time. The virus didn't just stop it. It's been going on for years. What I did see in the transaction data up through the middle of April is that volume really dropped off at the beginning of March, which we all saw the headlines that iBuyer activity, and I saw that in the D transaction data. Now they've been made announcements that they're coming back and slowly coming back into the market. Now, iBuyers are very sensitive to the risk and the holding period. And in an uncertain environment, they're going to be very cautious about coming in because they don't know how long they're going to wind up holding that house. And so I think they'll come back cautiously. But I think the thing that's bigger is the change in the business model. And financial crises and difficult times have a way of changing perspectives and changing business models. And what I see, or what appears to have happened here, is that single service, sole business of iBuying, that model is headed out the door. And you see now these pure play iBuyers starting to pick up, do other listings and provide more services. In the same way, you see well-capitalized brokerages finding partners to work with or doing it themselves to offer instant cash offers. So I think the business model is going to change. I think this crisis is speeding it up, but I think the pure players are going to disappear. And instead, what you're going to see is traditional brokerages having a division offering more instant offers, which then creates a very interesting ethical problem for agents. If an agent has the option, they're advising a client, do they advise the client in going with a traditional listing, or do they recommend to the client an in-house purchase of their property? Do you see the conflict of interest?
Yeah.
As traditional brokerages bring in these instant offer services, I think we've got a whole new can of worms to address in terms of conflict of interest for agents that are advising a client on whether to sell their home to the brokerage or sell their home in a traditional listing. So one other quick thing, we do see the hold period of iBuyers decreasing. And let me put in a quick plug. In what our senior data analyst, Josh Robertson, is doing an in-depth dive in iBuying. And in July, towards the end of July, we'll have a great story out on iBuyers and trends in the market and a real statistical look into iBuyer activity. So July, come to the Real Estate Center's website. We'll have a great article on iBuyers.
That's great. And you did share some slides that I want to show our viewers. Right now they're seeing the 2019 sales. So when you were last on this program, you said that the percentage was it was a single digit percentage of the market. Um,
Yeah.
so yeah, go ahead.
So what was interesting is that in that the iBuyers had the heaviest of activity in the heaviest zip codes where they
Mm-hmm.
were operating. They were accounting for anywhere from about 1.5 to 2.5% of the deed transactions. And those areas also happen to be the lowest price areas in town. Surprise, surprise. But they also happen to have the fastest rising values in town.
Mm-hmm.
So whether the rising values attracted the iBuyers or the iBuyers were driving the increase in the values. I mean, when you think about it, what does an iBuyer do? Takes a house, improves it, adds value to it, makes it nicer, and resells it. Of course, that's going to increase the value.
Mm-hmm.
So it's not necessarily that iBuyers are just driving up the prices, buying something and flipping it unchanged. iBuyers are also increasing the value. And again, it's not a huge part of the market. Again, 1.5 to 2.5% of the deed transactions where they're operating, but there's many areas where they're not operating. But the maps that I have here will help your folks kind of see in 2019 where the total market activity was, and can kind of look and see what the holding period, where we could calculate a holding period. We had a buy and a sell. They can look at the holding period, and then you can see in 2020, from January up until end of March, kind of what we had, what had happened this year.
Yeah, that makes sense. And I'm showing them the 2020 now. And again, if you stay till the end, we will be sharing many more of Gerald's slides. He put together a really nice presentation for us. So be sure to stay till the end so you can see that. Just a few people commenting here. Enjoying this information. You seem to be answering their questions before they can even ask them. So it's really good that they're getting their questions answered here. I had a few more questions for you. I know we're right at 30 minutes, but I do want to proceed because I know you have some good information on my next few questions for you. Since we are a few months away from November, how do you think the 2020 election will affect the economy?
Okay. For starters, I think you're going to see at least another $2 to $3 trillion more of stimulus packages. The first hit of stimulus is going to run out here in the next month and a half.
Mm-hmm.
We've got a president that's hell-bent on being reelected, and we've got a Democratic Party that's hell-bent on replacing him. There is not a politician in Washington, anywhere in the country, that's going to deny another stimulus package.
Mm-hmm.
I think we've got at least another one or two between now and November, which is going to be big. I think that, I've offered up a few different alternatives to kind of what I see going forward, but bottom line is, regardless of which party and which party controls Congress and which controls the presidency, there is going to be big debt monetization by the Federal Reserve. They've got the back of the housing market in terms of they will buy as many mortgage-backed securities as they need to keep the housing market going. So, for your audience, they're in what I would call a protected industry. Protected because it's a big lever for Congress and the Federal Reserve to pull to keep economic activity going. So don't expect any, at least in the GSE market, again, to that GSE market, there will be plenty of stimulus between now and November and for years to come.
Okay. A quick question here from the Knoll Group. With the average U.S. savings account being $600 and the impending mortgage forbearance narrative, what should the dialogue be with sellers and buyers?
A lot of it depends on where the house, what price the house is selling for. Again, it comes back to, now, if you're selling at the bottom end of the market and you're depending on selling to low-income households that have the $600 of savings, you're going to have a tough market, tough market to sell into because those buyers are under severe financial distress. I think that the pressure building with forbearance, both in mortgage and rent, It feels a lot to me like 2008,
Mm-hmm.
between March of 2008 and September of 2008. And so I think the conversation needs to be, there's a lot building up. If you can get things sold quickly, get them sold quickly. Don't hang on, because I think there's a second leg down coming in the fall.
Mm-hmm.
So get things sold. It's going to be tough at the low end. It's going to be tough at the high end because of the jumbo market. So it really depends where, and if you, the sooner you can get things sold, the better.
Yeah.
Don't hold out for the last dollar.
That makes sense. So you gave us through November. I'd like to hear your thoughts for 2021 and beyond.
Okay. Again, that forbearance pressure that's building up, we're fighting a debt problem with more debt. Even with mortgage rates at zero, you still have principal amortization, which means that households and businesses are going to be even more under stress. There's about 20% of US businesses that have a debt service that exceeds their internally generated cash flow. Think about that for a second. Businesses, and I'm sure many households, have, with this forbearance building up, have more debt that they need to service than income coming in. How does that resolve itself?
Mm-hmm.
I don't know. I don't have any good answers. And I don't see any good options out there other than pure outright debt monetization, helicopter money, increase everybody's bank account by 2 zeros. That kind of debt monetization is what I see going forward. I just don't see any really good alternative. And again, I go back to March of 2008 to September. There were losses building up in the system, and I could see that going on in 2008, and you can see right now that building up. And so I see a lot more debt monetization. In the short term, it's going to hurt demand, consumer demand. People can't go out and consume because they've got to struggle with debt service. So in the short term, it's going to hurt consumption. In the long term, it's going to become inflationary. Mm-hmm. And that's where hard assets, real estate and hard assets, are going to benefit. Maybe it's 3, maybe it's 5 years down the road, but eventually inflation has to come. And that's where real estate finance today at 2.5%, when inflation starts happening, is going to be a great investment. But it's going to be a long-term investment.
That's great. I think you answered someone's question here. Annette, excuse me if I pronounced that wrong, said, is it safe to say the renter's market is going to rise and investing would be key for those who can buy and hold? So that sounds
if you
on target with what you said.
If you can get a mortgage, and again, banks are increasing underwriting restrictions on rental properties as well. So if you're one of the lucky ones that is able to put a mortgage on a rental property for a long period of time at 2.5 or whatever the percent is, it's probably a little bit higher. But again, it's going to be a long term. There's capital appreciation coming, not in the short term with economic difficulty, but once we get through this recession, mm-hmm. you're going to see inflation, and it will be a great long-term investment.
Wonderful, thank you. And our members are thanking you for this information, great information in our ever-changing climate, so many confluent factors. Another question here, and it just moved on me, sorry. How does debt monetization occur? Explain the theory, please.
Okay. You heard the term sometimes banana republics, mm-hmm. where the government issues bonds, sells bonds directly to the central bank. The central bank prints the money and deposits printed dollars, into the government's account, and then the government takes and spends that mm-hmm. to try and boost the economy. Okay? Here in the United States, the way we do it is that the Treasury sells the bonds into the financial markets, and the Federal Reserve buys them out of the financial markets. Different route, but same concept of the central bank buying new debt from the government, and then the government spending it and showering it on the economy, and in a hopes to boost consumption, to boost the economy. And so when businesses and households are under significant debt problems like they are right now, the only one that's left to spend is the government, and the only place the government can get the dollars is if the central bank prints the dollars and sends them to the Treasury in exchange for Treasury bonds. Then the government can spend that money. That's debt monetization, and that's how a government tries to kickstart the economy when consumers and businesses are strapped and not able to spend.
Very good. That makes sense. Yeah, very good. I was just reading a couple comments there. Just some people talking about private money. This is where private money presents itself. Somebody said private money is drying up. That's why you're not seeing as many jumbo bank statement or non-qualified niche mortgages.
Yes.
Very good. So Gerald, anything else that you wanted to share with our members? And I'm several of them were asking for the website, and I know we put that in the comments, but you guys are also on social media. So there's their social media, and this is also in the slides that we're going to be sharing with you guys as well. Gerald, anything else that you want to share with our members before we wrap up today?
Something hopeful.
Okay, something hopeful. That sounds great. We love that.
It's the last slide, and it's not going to. It talks about the potential comeback starting in 2025. Mm-hmm. Demographics start getting better in 2025. I got if you look at the birth patterns, the baby busters. Okay, that's my generation, the Gen Xers. We're great spenders, but there's not enough of us. Starting in 2025, the Echo Boomers, the Millennials, the Gen Zers start hitting their earnings, enter their peak or their growth in earnings. That means, and there's enough of them, they're about the same size as the Boomers. If they so choose, they could cause consumption to increase significantly, something like what we saw the baby boomers. Mm. So starting in 2025, demographics get better. And if the millennials and Gen Zers are willing to engage in higher consumption, as opposed to the minimalists that they are, many of them are right now, we could have a rebound in consumption starting about the middle of the decade. So that's hopeful. In the meantime, we got a lot of work to do to fix corporate balance sheets, to fix household balance sheets, and to get the economy restored to where those millennials and Gen Zers can take us to another liftoff point.
Excellent. Thank you. So we're going to go ahead and share the slides in the comments. Gerald, as always, thank you so much for all of the information you shared. Again, the link that we're providing in the comments will it's about 25 or so slides that Gerald put together for you guys. But also be sure to be on the lookout, because every Wednesday we put out a weekly statistical report that's coming from the Real Estate Center at Texas A&M University. They have put that together for us so that we can now see what's happening, not just month to month, but week to week. So be sure to check that out. We put that out on social media every Wednesday for you guys. So be on the lookout. Again, Gerald, thank you so much for your time today. I know we went over a little bit, but it was such good information. I didn't want to stop us.
Okay. Thank you, Christina.
Thank you.
And thank you to your viewers.
Thank you so much. And they are thanking you as well. So that's it for this Member Focus Monday. We will see you guys next Monday at 9 a.m. Have a great week. Bye-bye.